Hey, hey, and welcome, true scalpers. And we know what it is. We know what we're 30 minutes away from our favourite scalping session of the whole month, NFP. Especially at the moment when the results are always wrong. It's great for us true scalpers, in and out of the market, taking those pips, and then waiting for a pullback or retest. Great stuff as always. And obviously last month we managed to do that magical $1,000 in 1 minute. So let's see if we can get a performance like that today. Would be would be nice. Any green is good at the end of the day. That was just a lucky one last month, and we're all set up. As you can see, we're going in on gold again. You could go in on US 30, you can go in on cable, probably USD against the CAD. Lots of different, even the UK markets will be affected. So, but obviously a lot of this is going to depend on the result. And obviously we just check. And 250 seems to be the general consensus in all the news channels and even on the websites and stuff. So we're looking for, you know, a possible lower number than this to send gold higher, and a higher number this to send gold lower. And obviously we like it backed up by the average earnings and the participation rate, and the unemployment rate is the main one, 3.7. That's meant to be exactly the same, which obviously the higher figure is what the Fed is trying to push for, believe it or not, to bring inflation down, more people out of work. So if this happens to be higher, lower, we could see some big moves. But the main headline number is going to be the 250 to look out for, and then we've got the backup. So if everything's the same color, we'll usually get a big move anyway. But gold's where we're at. We're on a 5 minute and a 1 minute time frame of our AXE trading system. And go to the website www.mohawkforex.com to gain access to it, but more importantly to be taught how to scalp like this and the techniques I use and other guys use in the group. So we're all set up nicely. We've got our Fibonacci auto fib on here, so to give me an idea of where price might go up to. A couple of nice supply and demand zones as well. So as you can see, gold's been ranging as it always does, just ranging along a little bit there, waiting for the result. There was a nice sell earlier on, and there was a nice buy, and then there was a false buy, again a false sell, and a false buy again. So all these three, you know, taken out of the equation because you're looking at the RSI and our trend line as well. And then we use our 1 minute to confirm whether we're at the top or the bottom of a band, and a momentum indicator as well. So that gives us an idea of how accurate the buy and sell signals are when they occur. So this buy one here, I might have nipped in on just to the center line and then got out. Depends how quickly you catch it. So that's what we're going to try and do with NFP. We're going to watch it progress on the 5 minute and then look at the 1 minute for the confirmation, so to get big moves. We're using the 1 minute time frame as well. As you can see, it's in a tight squeeze at the moment, so we'll keep an eye on that. And we are literally about 20 minutes away from the open. So yeah, I'm just going to go and grab my coffee, and let's plug into Bloomberg as well as I'm expecting.
And John, just quickly, November 4th is the next visit payrolls report, right?
There we go.
Week is right.
And we'll be back in a couple of minutes. I'm just going to go and top my coffee up. Back in a sec.
I mean, do you have a sense that the circumstances are moving faster than the lagging indicators of a previous month's jobs report can really give us at a time of such change?
Yes, you know, the Fed has been aggressive, and so it hasn't had time to really stop and see like what's happening in the economy. We are seeing signs of crack. We're seeing slowdowns. Where we saw, you know, this earlier this week, we saw a decline in the number of job openings. We're seeing slowdown in areas like semis. We're seeing more people announce hiring freezes. we're also seeing some cracks in the housing market. I mean, look where the mortgage market is. And so by the time we get to the end of the year, though, we think that that's when the Fed is going to stop and pause and sort of look around and assess this situation. We are looking for a 75 basis points hike in the November meeting, but we admit that, the fact is that dots were really close in the last September dots between 125 basis points and 100 points by the end of the year. But we think that we get to 4.25 to 4.5% by the end of the year. And then after that, we think the Fed will remain on hold to sort of assess the lag that monetary policy tends to have on the economy.
Nadia, just moments ago, John was talking about some of the price action, really fascinating price action. It's not today. It's pretty dull in a lot of the asset classes, but not in oil, not in crude. And we have seen that this week, this real incredible rally on the heels of what happened with OPEC Plus. How has the recent sort of machinations and political backdrop affected your view on the energy sector at a time when at one point people were saying it's overbid heading into a downturn?
I would tell you, Lisa, we have been positive on energy for almost 2 years now. We remain positive. I mean, the rally in energy has resumed, and it's really one of the few sectors that's sort of in this uptrend and where we aren't really concerned about the earnings outlook. I mean, we continue to believe that oil prices, Brent is going to move above $110, around $110 by year end, and remain that way above that level into 2023. And, obviously the continued upward pressure on oil will come from like the end of the SPR. We also will see the seaborne ban on Russian oil later this year. And then also there's going to be this switch in dynamic happening, increased demand away from natural gas, given the upward pressures there and substitution for oil. So profits remains very healthy in this sector. And so we continue to remain very positive on the energy sector and see opportunities there.
Nadia, are we redefining how we play defense in a downturn?
Yes, I mean, it's sort of like traditionally you would lean into all of the defensive sector. We have two of those defensive sector, as I noted, healthcare and consumer staples. But energy usually has been a more cyclical sector. But we think that there's opportunities there because we're less concerned about the demand picture on that, even in a downturn, because the supply market remains so tight. So you sort of have to have a balance in this sort of new environment. It can't all be traditional defensive sectors.
What about the banks? How do they fit into that theme?
The banks, we've been neutral on financials just given the macro uncertainty and market volatility in capital markets. But as we head into the earnings season, banks kick off that next year. The banks might actually have a decent setup. They should be able to benefit from, net interest income side, given just the fact that we've had this increase in interest rates and also pick up in loan growth, particularly on the commercial and industrial and consumer side. But that might be able to offset some pressures on the fee side. But like I said, we've been neutral on banks.
Right, and we're back. Coffee's topped up. Let's log into our broker, IC Markets, of course, and we're making sure we're going to be on gold. And let's have a look what lot sizes we're going to be looking at.
Nadia, thank you.
So we're going to be trading with basically $1,000 account today. So
redefining defense in the equity market, talking about energy going into a recession.
We'll probably go 0.4 or 0.5.
And you're starting to see that. And when we
yeah, 0.4 will do. It's the only positions we can get away. So that's 40 cents a pip, basically. So we'll just see how many. I've got a preset take profit level for all the trades of 300 pips, which is 30 pips, but 300 on gold. So if there's a spike and I'm in a trade, it'll automatically take me out of the trade at that profit. It could go higher, of course, but I just want to edge my bets and make sure that I get some profit locked in. So like I said, it's not a pending order, it's just something you can do on IC Markets where you can have a preset take profit to get out as soon as you click the trade. So that's a handy little feature. Good to have that one. So I'm guaranteed that if we get a big spike. And then we'll just wait for the retest. But obviously I'm looking here at levels. If the news is worse than expected, then obviously we could get a rise up to that 1714 level. You can see here it's been retested pretty much 1, 2, 3, 4, 5, 6 times to break that kind of 1715 So I would definitely put a line across that. And then if it's the opposite and we're looking to take sells, and obviously we're going to come down to 1706, bottom of the fib. So that's kind of our, if we can switch over to the 1 minute time frame, you can see here, that's kind of the area I'm looking at where I could get a pullback. Either here, drop down, bounce, here, pull up, face breakout, and then pull back again. So if you miss that initial move, and you will do, because price will move before the news comes out, we know it all the time, there'll be a big shoot up, big shoot down, but that initial direction is pretty much mostly the same direction the market will go in. It's very rarely it shoots up red and then goes green automatically. So if you miss the initial red, just wait for it to expose some wick, then go back in. That's kind of what I do. Again, this is not financial advice or anything, I'm just giving you the techniques of what I do for entertainment, of course. So that's what I'm looking at. We're set up, we've got an idea of where price might go to and retrace to. It could bounce before that, but if it's a strong result, it will usually click to the last decent support and resistance zones, which you can see here, 1706, 1714, perfect. Then we'll get a continuation, and then we'll get a pullback back into the center. We know the pattern, how it does it, how it retraces, so all we're going to do is sit tight and wait. We'll just zoom in on that, keep that sweet. Just going to post this into the group so everyone can see.
What is the main reason institutional investors give you for not adopting crypto?
There's still a lot of regulatory uncertainty. The U.S. has been not good at making things clear. What's a security, what's not a security.
And we can have a quick look at US 30 as well. Just want to change my chart. I've got it on the German DAX, shows up to US 30, and we'll mark NFP on here as well so we can see the result. I would usually go in on the US 30, but today I fancy a go on gold. And again with US 30, it's breaking its levels now, as you can see, look already. So it's harder to predict on the top side where price might go to. Could be up here somewhere. On the downside, obviously we've got some areas of good support. So that's why I like the look of gold better, because we're not in an extreme look, we're already pushing. Gold is where I need it to be. You want to be ready. It wants to be in a range, basically. Any news event you're trading, any market open you're trading, when price is in a range and center, whatever indicator you're using, that's the best, because then you're going to get that spring. If there's already a trend and a continuing trend, you don't know whether it's going to continue to trend that way or pull back, or if there's a pullback, is it just a little pullback before it goes back to the trend again. So this is where ranging markets are better for scalpers, because we know the move is going to be one way or the other, and it'll be a big move that shouldn't retrace straight away. As like I say, in a trend, you know, you just don't know if it's a pullback. So gold is set up way better than US 30, as you can see. US 30 is top of the fib, top of our bands. You know, bit of low volume, it's in and out on the trend bar. It's not, you know, still tradable, but like I say, it'd be, if it's a sell, it's going to be the better one. Like I say, we've got about 10 minutes to go. 10 minutes to go on gold, so we'll just sit watching this, and we can adjust our zones if we need to, if price moves. Look, our fib, it's a moving chart, remember, everything moves. So and then we're going to see what we can grab on gold. Let's just look at the latest news as well.
got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have
I've been in and seen it.
lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Part of what I love about business is you get to build things from nothing. I don't have any investors. All this is all money in. This is me just building it.
It's pretty much full service shadow banking with nobody in charge.
With inflation running well above our 2% goal, restoring price stability likely will require ongoing rate hikes and then keeping policy restrictive for some time until we are confident that inflation is firmly on the path toward our 2% goal.
Lisa Cook, the Federal Reserve Governor at the Peterson Institute for International Economics, her first address as Fed Governor. Very cool. Congratulations to her. Live from New York City this morning. Good morning to you all. Counting you down to payrolls. The number, the data, 12 minutes away. Equity shaping up as follows. Not doing much at all in the equity market. We're up about 1/10% on the S&P. Yields are higher by almost a basis point at 383. Euro dollar going absolutely nowhere at 97.92. Unchanged, 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 Lisa, going into this one.
Except for one figure.
Crude.
Yes. And we're seeing that increase pretty substantially, up 1.6%, following a week of gains that really has been extraordinary, especially given the downturn that people are talking about, not only now, but over the next 6 months with what the Fed is going to do.
We're going to get things set for you. Mike McKee's going to enter the building any moment now. He's going to sit around this table. Randy Crozen's going to help us break down this number too. He joined us, the economics professor at the University of Chicago and former Fed governor. Randy, great to catch up with you, sir. The number about 11, 12 minutes away. Walk us through what you'll look for, first of all.
The key thing is want to see if the labor market is beginning to weaken. I mean, since I'm from University of Chicago, I'll invoke Milton Friedman's famous phrase from 60 years ago that monetary policy has impacts with long and variable lags, and that's just as true today as it was then. That monetary policy we typically think of as having an impact in 6 to 18 months. And it's about 6 months now since the Fed started this tightening cycle. So I think we're going to start to see some weakening in the labor market.
Randy, given the fact that you were once a Fed governor not so long ago, can you translate for us what we can understand from Chris Waller's discussion of basically point by point taking apart all of the bullish equity strategists out there, every argument that they have?
Have a look at cable as well, because cable will move. Obviously we've got our cable trade for later, but obviously it's hard to take readings for that when you've got NFP in the way. So we're just going, if we're going to trade cable, which we grabbed 10 pips this morning on the buy up to our level, which is really good. You can see here, look, we entered here and there was our TP. It went higher, but we took 10 pips and that was totally fine. You could have got 15, I got out at 10. Did 4 trades, 5 trades, whatever. So everything was green, that was good to go. So the New York session one is going to be a little bit more difficult because NFP will skew it, so we'll see. But it will move as well. Cable will move on this. You can see it's on trading view here, look, already. So again, any problem with pound dollar is similar to gold. You just got to watch those spreads and the commissions. So I just think gold will move a bit more fluid on the result, if the result is a big deviation from that 250, which as scalpers we hope it is. You know, it's the whole point. We want markets to move so we can take advantage, get some green and get out. We don't want to overstay our welcome. We don't want to stay in the trade too long. And again, I'll try and do as many as I'm allowed to, with margin obviously, as many positions as I can, and then end them in the green, and then try and go back in again or catch the bounce, and then that's it. Couple of banks of trades and done. You get caught out of NFP when you start holding too long, or when you're into the third or fourth candle past 15 minutes, because markets on the whole will start to pull back, and if you've missed it, then that's it. So it's going to be interesting to see.
They're going to get to low fours relatively soon, and then I think they're going to stick there, and they want to make people clear that they're going to stick there. Now, of course, you know, Mr. Putin could do some things that upend everything, but I think they're pretty strongly committed to this.
Randy, they're not going to keep hiking.
The gold now, beautiful, is keeping this nice tight range, and then we know we're going to get a move. And like I say, if these levels are hit, perfect. I mean, you're looking at 487. Remember, my trades will take me out at 3, and then to the downside, we're looking at 292. So I'll just be triggered out my trade about there. So these areas again don't need to adjust at the moment. The fib's still nice and tight. Again, no doubt some people will set pending orders based on these levels for take profit, and then you could just, I've seen people do it where they place trades, you know, kind of just above here as an entry point and just below here as a sell, and then, you know, let the price trigger it and then wait for the TP and then end the other trade. You can do that, but it's risky because when it starts spiking, when you get these big rips, the big saws, then, you know, you could trigger your buy sell, trigger your buy, trigger your sell, and then obviously one will only win, the other one will lose. So you kind of just blown your account, or a little broke even, and you end up panicking as well. So this way, entering manually, entering at the market price, which will obviously be slightly different on your broker. The price is irrelevant, that's why I don't do pending orders, because it will be the movement that you're after. It doesn't matter if my broker is 3 or 4 pips out from what TradingView is saying, because it's the move I'm on about. It's not the actual figure. I'm not bothered if it's 1709 or 18010, or it doesn't matter. You know what I mean? It's the move I'm after, and if I'm confident that the move is going to be more than any spread or commission, then that's all I want to be worried about. That's why I try not to. I don't trade like this when we're outside of news events or market opens, because the market doesn't sometimes cover those, especially when you've got multiple trades. So that's why it doesn't concern. That's why I don't do pending orders, because every broker unfortunately has a different market price at the time. And also there's delays, like I say, when you click live. That's the other disadvantage, is I might click 9 or 10 positions and maybe only 3 or 4 are filled, maybe none are filled. I mean, sometimes brokers can be a nightmare with it. So again, it's pot luck on it, but you're not gambling, you're going with the way of the market. It's just how many trades you can get away.
We could look at the unemployment rate and the participation rate, but the Fed's kind of gotten to the point where they don't think the participation rate's going to go up a whole lot more. So let's look at the headline number.
Here we go.
One thing, Mary,
oh, they're saying 255 now.
We are data dependent, and data is a plural word. So they're not just looking at PCE, they're looking at every other inflation measure, and they're looking at their labor measures and UMISH. They want what was the word? Totality?
The totality of the data. Okay, that's helpful. Mike, looking forward to you breaking down the number. Jeff Rosenberg of BlackRock is going to be with us too. Randy Krosner back with us as well to break down that number in about 4.5 minutes time. Going into it,
here we go.
The stage is set for you. The equity market doing not much at all morning on stocks, on bonds.
So get ready, everybody. We're on gold. As you can see, we're approaching the line.
It's knocking it out of the ballpark.
It's a challenging dynamic.
Keep that on in the background. Make sure I'm logged in. Make sure I'm at the right lot size. All these things you've got to double check. The amount of times I've clicked on the wrong thing and entered entered the wrong instrument I'm trading, or you've not got your lot size right, just because you're not awake, or you know, you're just not with it, and that's where a lot of mistakes are made. So check you're logged in, check you're doing the right lot size, check you're on the right thing that you want to be trading. So I'm on gold, I've set it for 0.4, and we're literally 50 seconds away. And you can see it's the countdown now. Good luck everybody, and let's see what we can bag. Get ready for the market to move. There's going to be a big spike. So I'm just going to take this yellow line out of the way so we can see the price action. Move that over to here. Got 10 seconds. Right, let's see if it hits our levels as we said. There's the move, it's the sell, look at that, beautiful. Now it's going to pull back, wait for that wick to expose itself.
One of the most important things is looking around the corner.
Let's have a look, we just got a load of trades away, we're just trying to clear some out now. Excellent. Woohoo, what a sell, beautiful. And look at the result. And the result was 250. Look at that. There's the sell. Now how many positions did I get? Wow, I clicked that so many times. And I caught some nice ones on DAX as well. Had some trades that I set, so it's beautiful. So let's post on that. And we cleared about $600, $700 there. Look at that drop down, it's beautiful.
Very close to what the consensus was. The unemployment rate drops to 3.5%. Guess there is that we had fewer people who were looking for work. We'll take a look at that in just a second. Average hourly earnings up 0.3 on the month, and that pushes the year-over-year number down to 5%, which was what was expected.
So 263. So not too far, but it was better. It was a bigger news event, and that's what caused the drop. As we say, when it's a better than expected news event on gold, it's the reverse. So high, all green apart from one, so that means a sell on gold, and that's what we've got here. Now look at it, it hit my TP, lower TP on the sell, just as I set.
I've got caught out too many times coming up with nice little neat narratives around the payrolls report and the market action, Mike, and then I've got whipsawed by the price action several hours later, but I can give you the knee-jerk reaction right now. Futures down by 0.75% on the S&P, positive by about 1/3 going into the print, coming out of it. We are negative.
So that was brilliant. I mean, I just I wanted to try some positions out on DAX, and I did as well. And that was the same. DAX dropped nicely. But look at that on gold. Amazing. Look at that.
The downside surprise in unemployment.
US 30 as well. Crashed.
Number in exceeding the forecast isn't that great. It's 13,000 higher. We saw 11,000 higher for July revised up, but August isn't changed at 315. So labor market strength.
Look at the move. So you could have done US 30. Look at that drop.
But then it becomes a question of who's getting the jobs and how many people.
Now it's just pulling back. Wick is exposed. So that drop on gold on US 30. Wow, look at that. That was 3,200. Wow, points. Amazing. Now it's looking for pulling back. Gold's the same.
by 204,000. The number of unemployed falls by 251.
In some ways, on the margins, not an extraordinary move one way or another, but on the margins, this is exactly what the Fed does not want to see. Because what you're seeing is a shift away from the perfect landing.
It's bad for the Fed.
More people coming into the labor force.
Good for us scalpers.
A bit more slack to potentially loosen some of the price pressure.
We'll just see if we can get any more trades away. That lower level's been breached. Look, you can see that's the support level. It's bouncing off. My yellow line here that's set on the 1 and the 5 minute. So TP was perfect. So like I say, as you set your TP at those levels, bang.
Away from their goal because we did see the JOLTS numbers come down and the number of job openings are falling. And Mary Daly, the San Francisco Fed president, was in here the other day, and she was suggesting that the unemployment rate would trail other indicators because there are a lot of jobs available.
Brilliant. We just cleared out on the buys there, got in on those buys. You heard me clicking away. What did we get? 1, 2, 3, 4, 5. We got another $100. So not a big of move as last month, but we still bagged
by the end of the year. Because of that, we're going to see
some big pips. Nice buys and pullback. And that's what you got to do. If you miss that move, don't get disheartened. There's always a pullback, and look at that. Look at it pull. Now we're back to where we were. So that was your drop, and that drop was amazing. Look at that.
75 is the bar, and it's going to be hard to bring that bar down for the Fed. And this number would tell you that 75 is, you know, what you want to do because the labor market is still strong enough. I don't think CPI is going to fall enough that we get down to 50. And I think, you know. So
that's great. We absolutely smashed it out of the park. So well happy with that. So I managed to get away 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18 trades on gold. Took one loss of 674, and then I managed to bag 1, 2, 3, 4, 5, 6, 7 trades, 8, 9, 10 trades, sorry, on DAX, and they were all green. So perfect, and they all hit TP literally 20 seconds after.
That's a joke.
So I was well happy with that as well.
Just a joke. Space for humour. Mike McKee, thank you. Randy Closer joined us now. Economics professor at the University of Chicago Blue School, former Fed governor. Randy, we'd love your reaction to this. Futures down just a little bit. We're off 0.4%. Your thoughts on this report?
So I think exactly as you were describing, it's going to keep the Fed on track for 75 basis points.
Now pulling back down again. Look at that, see, on gold. Going to hit that level again. Just retesting that zone.
They'd still see a little bit more uptick in labor force participation, but they didn't get that.
Brilliant. We just got another, what did we get? Another 10, 20, 30, 40. Took a 296 loss. But we've got another 5 positions there on that candle pulling down.
So I think that's the other key thing to be looking at going forward.
Because obviously the sell is the way it wants to go, and you just had a nice little retest to clear out people. So I mean, people with pending orders, that spike there would have taken you out.
Let's stick on participation rate for just a minute. We haven't gotten back to the pre-pandemic levels, and a lot of people were hoping for a soft landing.
Again, we're on the support area, so just going to wait, see if gold breaks.
During the pandemic and the direct aftermath, how does this rejigger the expectations of the Federal Reserve, of this labor market, how much it's been transformed post-pandemic?
Well, I don't think this one report is really changing that, but I think they're gradually coming to realize that a lot of people are just not coming back in. For example, older workers.
So there's a 70%.
Quite high before the.
So we started with 1,000, and now we're 1,700 and. 1753. There you go. And that's in 8 minutes, so I think that'll do quite nicely. So, and that's it. I tend not to go again. I mean, you could go again if you want, but you just risk it because gold wants to go back eventually to where it sat from. It's a beautiful, nice sell. 5 minute, we've got sell, sell, sell. RSI, trend bar, and everything. So this could push down a bit lower.
On Twitter, reminder, be sure to fit today's labor market report into your narrative.
Looks like it wants to push down
How does
to the next level.
Change, or what should the narrative be heading into year end as we look at the multitude
Back down to retest maybe.
And try to understand where we are in this
1701. It's at 236 now. So again, usually 5 minutes and then that's it. You know, I just don't want to risk it. I got that initial move. As soon as we saw that candle move down, see, price action leads the way over the news. You saw the red candle shoot down before the news came out. Now again, not saying it happens every time, but it's very rare that the candle will shoot in one direction before the news event and it swings back the opposite way. Very rare. I mean, here it entered here 30 seconds before we got the news event, so we banged the sells in, we grabbed our pips, then you get the market manipulation to try and wipe people's pending orders out. That's what I mean. You say, why would it spike up here other than that reason? The market makers forcing it. If people had pending orders for buys here, look, you'd go, yeah, I'm in. Oh god. And if you haven't got a preset take profit level, you'd be tripped out because look, it didn't hit the level that we would have wanted if we were taking the buys. It's all clever manipulation. Then the market goes back to where it was on NFP and it ranges around a bit waiting for the next move. And that's just, this pattern is repeated every single time with a lot of news events, but mostly it's a smaller move. But with the NFP you get this manipulation, so understanding that, and then if you miss something, waiting for the next move.
Reaction from the White House. Lisa, looking forward to catching up with Secretary Walsh in the next hour. Something for everyone in this jobs report, right?
I really enjoy that Twitter post where basically people are saying you can find anything you want, take your narrative, just use shoehorn, stick it in.
So it's good. Unemployment rate lower,
quite clear. This labor market is still pretty
wages higher, private higher, partition rate about as expected, average earnings the same. So unemployment rate low. So everything predicting better than expected, but bad for the Fed, bad for inflation, gold drops. Yeah, it's just a simple way. And again, that's not every single time, but 80% of the time, that's how the market moves.
And it comes at a time when people are seeing a punitive level of inflation. It's hurting the lower income.
So now we'll wait for the New York Open and see how the market reacts. We'll switch to US 30. I think we'll leave gold alone now. As you can see, look, it's ranging along that support zone, our initial TP. But well done to everybody for if you got in on that and followed. It's a technique. It's easy to do. Just got to practice it, paper trade it.
As I'd say, Mike McKee, before we get on to our next guest, I'd love your take. You've been parsing through the data. What have you discovered in terms of some of the nuances?
So let's look at US 30 now.
We looked at what happened with the unemployment rate, but the interesting thing about employment is that we did see a seasonal effect, it looks like, in education. State and local education lost 20.
That was a great move, though.
Which is going to be seasonal.
Real big. To say the result was not far away, that's close again, like last month, to the actual consensus. That was a hell of a big move. Just shows you how at the moment fundamentals are leading the way. Everyone's looking for data points to predict what the Fed's going to do and what's going to happen with inflation. So fundamentals more than ever have taken a front to trading, and especially our scalping as well. So this is great way. If you want to learn scalping, now's the time to do it, because you know the cards are stacked in your favor. Because you're getting these moves that will wipe other people's accounts out. We're trading them. We're trading them, you know. So that's it for the news today. As you can see, it's just going to be how the market's going to react on the open, on the US 30. So we'll set our line for the open.
Revisions on the heels
there we
of
go.
Some of this weakness and expectation of that. Jeff Rosenberg joins us now following the labor market report that we got pretty much bang on for the expectations. BlackRock portfolio manager of the Systemic Multi-Strategy Fund. Jeff, your take on this particular jobs report?
Let's have a listen. So we'll just post that.
I think you hit it on the head earlier in your reaction to the unemployment rate and the labor force participation rate. I think that's why you're seeing, you know, a little bit of negative reaction in the front end of bond curves, a little bit of negative reaction in in equity futures. I think this is a slight disappointment relative to hopes that this report would give a piece of evidence in favor of the camp that there's.
So we'll switch to New York to US 30 for the New York Open.
Disappointed in this report. It's one report. It's probably not even the most important report. Next week we'll get the most important report, which is the CPI report. But I think in total.
And as you can see, we'll see if US 30 is gonna. If it stays as it is, obviously I'm looking for the buys. The buys are the edge where they're more likely to happen, but it can still go down further and further, as we know, But just as a scalper, I'm wanted to take buys. I want USC to pop back after that NFP. We've reset our fib, as you can see. The fib is now reset. We're oversold. RSI is 23, so we're just going to sit and wait. We need to see some candles pop back inside. See here, look, you could have nipped in for a cheeky little buy on that green candle, just like I did on gold, and you could have got yourself, 50 pips, look, just on that little move.
Minor on both sides of the argument, but definitely tilting that way, and that's why you're getting the market reaction you are today.
So we get a lot of fund managers on the show, and they always say, we're not trading every day, we're not an algo, and they say, we have a certain approach and we kind of move along. How has your approach shifted?
Unemployment rate, yeah, 3.5.
Data that we're getting, and how much are you looking to change it heading into year end?
Well, it's a great question, Lisa, and the issue is the degree of uncertainty here with regards to the inflation outlook, and it's very hard to forecast. So we have a little saying: if you don't have a good forecast, then observe. It's sort of what the Fed is saying in terms of being data dependent. They don't know what the trajectory of inflation is going to be, and so they're going to observe. So it's very hard to kind of trade every little change and turn in the data. We take a step back and we look at the overall trend. And as I just highlighted, this is one piece of information that's a little bit in the camp of the hawkish camp that the Fed needs to do more. But no one really knows where inflation is going to go. And we have expectations, however, in the bond market and the consensus view of a relatively benign amount of impact to the economy for a dramatic decrease in the amount of inflation. And I think the weight of the proof of that being the correct view is on that side of the argument. And so I think it's highly uncertain, and today is a little bit on the hawkish side.
You can't trade every little data point, you say, but yesterday we saw jobless claims up just a little bit, still very, very low, and markets turned around. When are they gonna get the message that the Fed is sending and just kind of sit back and let the economy go, because the Fed isn't going to change its mind?
Well, the Fed is sending mixed messages, right? If you look at the distribution of the out years SEP median Fed funds expectations, they're all over the map, and they represent basically it's time to slow.
US 30 up, pulling lower, as we said.
The over tightening camp.
We can have a look on the 5, zoom out, see previous levels, and there you go. Look, here's a nice little zone. Ooh. So that's the supply zone. So price is about on that now, just broke it.
And I think they're trying to get as much as they can under their belt while labor markets are strong.
It's going to be interesting to see if this holds. There you go. There's a false break back. Again, we're in no rush now. We've taken some good profits, and we're going to go again for the open, and then that's it done. That's NFP done for this month. So again, yeah, it's been a good one. Quick. You build up to it and it's over in a flash. It's kind of like, and I know the temptation is you want to keep trading it, you want to keep trading it because you want to miss and you want to get more, but literally you've just got to get that initial move. Do I like say you don't have to follow me, but I'm just saying, just you do that initial move, wait for the one kind of retest or fake out, trade that, and then done. That's it. Be strict. The amount of times when I first started doing this, I used to win in the first 2 or 3 moves and then give it all back to the market just purely I was greedy. I was going, I can trade this for 15-20 minutes. Yeah, I'm gonna, you know, it's gonna just continue in one direction. It never works out like that. I mean, it is today on US 30. Obviously, it's just going lower and lower, but you know, you've got some big serious spikes here that you've got to hold your nerve for that go against you. If you're holding a sell from, you know, here and then from when you say the bottom of that first candle, and you were going to be 60 pips down, drawdown. Now, if you've got real small lot sizes, which you can't have too small in US 30, that's still going to be a lot of money to sweat over. That it isn't just going to bounce back on you. So it's all about nerve, and you know, I don't want to be in the markets any longer than I have to. So catch that move. If you miss this, you know this is going to happen. A pullback, you know, a stop loss hunt, whatever you want to call it, and then you trade the continuation, which you got now. As you can see, we're well oversold. RSI's 20. Trend bar's still red. We're still pushing lower because obviously this is, you know, not great news. It is for the jobs market, but not for stocks and stuff. But we've got some really good momentum. Look at that. I mean, we're well up 50. This is pushing well down.
So next week's number is going to be very important in a sense. The Fed has said 75, so unless inflation...
Yeah, next week is CPI, so it's just as important. That's going to be just as a big news event.
What they would like to see is some progress in bringing down some of these prices.
And we were speaking with Anna Wong of Bloomberg Intelligence earlier, and she was talking about how she could see a 5% Fed funds rate. That's ultimately where they're going to get to. How divergent is that from the rest of Wall Street?
It's not as, well, from Wall Street, it's higher than Wall Street wants it to be, so it's higher than most of the forecasts. It's not that divergent from where the Fed is because most of them have marked up their numbers. They're between 4.5 and 5. So if inflation proves sticky, you'll see those numbers go a little bit higher, maybe over 5. Given where we are now, they think that if you get to between 4.5 and 5, that's going to be enough to put the brakes on inflation in the economy, but we won't know for some time.
As we look right now, we're looking at a 2-year yield of 4.32%, touching earlier the highest levels going back to 2007, just off some of the initial highs. But nonetheless, a knee-jerk reaction that this will give the Fed more rope to continue to hike rates aggressively into year-end and potentially beyond. Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence, joining us right now. Ira, your take on this labor market report?
Yeah, so I think I agree with some of the former guests, basically saying that you can find anything if you're hawkish or dovish in this report. I think generally speaking, it was middle of the road enough.
There you go. Increased to 265. Market's down. That's a good screenshot actually to show you how the markets are reacting.
Basis points in November. There's nothing in this report that should change that outlook. I think something that's interesting that we've seen, just in the market post the initial knee-jerk reaction was that the yield curve has actually steepened a little bit. We were flatter going into the number. The 2s-10s curve was a couple of basis points flatter. Now we're about a basis point steeper on the day, and that might reflect just some of the forward uncertainty that some of the incoming data certainly represents. And when we look at the Fed funds futures about the terminal rate pricing, we are starting to price finally for the Fed to stay at its terminal rate a little bit above 4.5% for most of 2023 now. So before we were talking about early cuts, now the market's only pricing maybe one cut in 2023. So I think that's a significant change since over the last couple of weeks since the last Fed meeting.
Ira, I'd love your take on what Jeff Rosenberg was just talking about, that perhaps some of this data is really highlighting the point that was put out by Larry Summers and a number of others, where they're talking about the Fed funds rate needing to be much higher than people previously expected because of the stickiness of inflation, and perhaps we'll get that with CPI. Certainly with the labor market, it is holding in much more than people thought. Are you sympathetic to that view that the terminal rate is something closer to that 5% level of your colleague Anna Wong?
Yeah, so we've been above at 4.5% or a little bit higher than that since May. So you know we're now pricing for our forecast. I think the Federal Reserve can hike to around somewhere in that 4.5 to 5% range. Call it 4.75 on the upper band, which is exactly what the market's pricing right now. But by the way, and then hold it there for a while, right? Because the Fed at some point is going to say, look, the long and variable lags point of view, where once we get to that level, we can hold it there for a long time. Now, from a market dynamic standpoint, if that's what happens and the market starts to expect the Fed to be
So
on hold
US
for, say,
30
the better part of a year and a half, at
now looking to pull back.
that means something like 2-year notes can probably sell
Going
off
to
a
curl
little
up
bit more
RSI, see if it's going to come out the zone,
they're currently priced. The question
get
then
back
is,
into that
what
neutral
does the long
zone.
end do?
We'll follow
Does
that.
the 10-year and the 30-year, do they expect a re-acceleration of inflation and the Federal Reserve to have to hike more, in which case you probably get a steeper curve or less inverted curve than what you have right now. But if the market is thinking that, hey, we're going to go into a recession, which I think is still more or less the consensus, that then you can wind up with even a flatter yield curve, and you can see 10-year yields rally a lot more and see maybe 3.25% 10-year yields next year, where you still have this
Just sit and watch.
high 2-year note yield. So I think it's really the curve dynamics that are going to be interesting, and I think some sectors like the financial sectors, for example, like banks, that can seriously affect some of the earnings potential outlook in some of those sectors.
Ira Jersey of Bloomberg Intelligence, thank you so much for your insights. As always, Mike, what do you make of this whole discussion of a fully employed recession, of something where we don't necessarily see the labor market participate in something of a downturn that, as Ira was saying, is sort of turning into a base case?
Well, employment is lagging, first of all, so from history you know that it's going to take a while to come down. This has also been a very unusual economic recession and recovery. A lot of supply issues. We shut down the whole economy, reopened it, and a lot of people dropped out of the labor force. So it's kind of hard to get a good read on all of that. But I think the bottom line from all of this is that what's going to happen is going to take time. It's not going to be an immediate collapse in inflation.
Price breaks of these two lines here, the zone. Then we're going
now 2.7%. We'll see what it is after
back
today,
up.
For the third quarter. So a big rebound in growth at a time when the Fed is raising interest rates.
Let's keep an eye on the RSI.
People on the Wall Street trading desk, they're going to have more patience than perhaps they do.
And perhaps it's going to be a little bit more immediate when it comes to corporate profits. And we've seen that from a number of companies. Gina Martin Adams has been tracking it, and she joins us now, Chief Equity Strategist for Bloomberg Intelligence. Gina, in your examination of some of the recent earnings reports and guidance that we've gotten out, how much and how quickly is the mood shifting in corporate executive C-suites rather than just looking at these sort of broad macroeconomic data points?
Yeah, I think the mood has shifted quite materially, frankly, over the course of this year. We've seen companies migrate from their primary concern being inflation to their primary concern being a combination of the extreme currency volatility that has been recorded over the course of 2022 and a recessionary-like slowdown in growth conditions. We've definitely seen this start to show up in consensus estimates as well. As far back as June of this year, analysts were forecasting 10% growth in earnings for the third quarter earnings season, which we're about to go into. Now analysts are anticipating.
So we've got no positions open, so just waiting, watching, see if we get a break back inside. Just going to go back to looking for that 10 pips.
That at our September lows, provided an assumption that the bond market had the outlook for rates correct, the market was pricing for a 15% correction in earnings over the course of the next 12 months. Even if you get more aggressive on the rates forecast and you suggest that ultimately that terminal rate does get to 5%, and reflecting that the 2-year yield.
Just looking at our results and stats. So September, August was 83.64% win rate. September was 81.68. And October was so far at 89% win rate. So happy with that.
Specific to the semiconductor.
July was 85. June was 70%.
Names that make up the index.
Well, if you look at consensus expectations as a proxy for what we are likely to expect for the third quarter, the analyst consensus thinks that
So this week we've been 87%
or a drop in earnings relative to
is the
that
win
of a
rate.
year ago as of the
So
third
it's
quarter.
good.
In the second quarter,
We achieved 91% on US 30, 85% on DAX, 70% on gold, 100% on cable, and 100% on Euro USD. So that's good to know.
The weakness is predominantly about
Checking the stats.
as opposed to revenues, but nonetheless, even the revenue forecast is deteriorating.
But Gina, I actually want to pick up on this, and just in the minute that we have left, how surprised have you been that they're willing to sacrifice margins and to not lay people off to cut costs in order to preserve workers through a cycle after just getting burned by not having enough people or being able to bring people back after the pandemic?
Yeah, I think it's a very difficult cycle, frankly. So I think this has been a surprise, but also sort of a consequence of the duration of this cycle. We were just in recession in 2020. So we haven't had the opportunity to really develop sort of a full economic cycle and then see removal of some of the excesses that typically develop in an economic cycle drive recession. So this recession is a consequence of very different factors than the normal type of earnings recession. A lot of it is, frankly, very tough comps from a year ago, because remember in 2021 we were experiencing extraordinary earnings growth after the 2020 correction in earnings growth. So it is very complicated. It's a much different cycle than is the norm, and inflation is clearly also in a very different position. Much of what we're seeing on margins is simply reflecting input cost changes and input cost volatility, which is clearly quite different than companies have been contending with for a long time. You have to remember that over the last decade, we've had very, very suppressed inflation, very low inflation volatility, allowing for margin expansion to sort of persist.
Alright, just making sure I'm logged into US 30. We've got 30 minutes to go. Yeah, make sure my lot size is, again, just going to the smallest lot size, so that's 10 cents a pip. The market's declining, but there's that nice little tasty pullback I said. Is it going to go back into our bands here? Look.
Stocks down, pretty much the playbook that we have seen. Coming up,
Got a nice buy signal. The buy signal is valid, as you can put a line across it and see when that sticks. So from here, that would have been a nice buy.
There's still a lot of regulatory uncertainty.
And they jumped in on that. Now we could hit some resistance here, see if price breaks back inside. But that's how I confirm any buy signals we get on the Axe trading system. I don't just blindly enter, I check them and I look on the 1 minute. Volatility is right. Green candles. Yeah, the bigger trend is against us. We're pulling back on the RSI. Main trend still to the downside, as we know. You can see it here. So we're just trading little pullbacks. These ones you dip in, get green, get out.
This is Bloomberg, the Open with Jonathan Farrow.
Yes. Let's do this. Our final trades of the week.
Live from New York, we begin with the big issue. It's Jobs Day in America.
The jobs report.
The U.S. labor market data.
We still have a very strong labor market.
It's going to keep the Fed very much on their mission.
We're in this period where every miss or hit or every economic information becomes so important. The Fed is
yeah, that's what I'm saying. Every fundamental news now is important.
They are going to be tone deaf to slowing in the economy.
Participation is really the key to the Fed being able to pull off that soft landing.
The participation rate has been so critical.
It's a huge element.
They are talking very tough. They're sticking to a script.
They're going to want the data to tell them to start to cut.
There's nothing in this report that is going to suggest to them that they need to pull back.
That's it. Going to keep them rates being hiked.
Morning, John. Slightly stronger than expected. 263,000 jobs added to the payrolls in the month of September. The August number of 315,000 was unrevised.
Excellent.
The unemployment rate, though, falls to 3.5% as the participation rate drops a bit. 52,000 people dropped out of the labor force. Last month, we'd had 768,000 additional people in the labor force, and that's why unemployment goes down. Average hourly earnings come in bang on expectations, 0.3 for the month, and a 5.2% for the year, 5.0% for the year, which is a little bit of progress for the Fed. In terms of the jobless story, Black and Hispanic unemployment, 5.8% and 3.8%, both of those dropped from the prior month. The U6 drops to 6.7%. And as I mentioned, 57,000 people fewer in the labor force, while employment went up and unemployment went down in the household survey. There are some interesting changes. We would have had an even more stronger report if we'd spread the number of teachers and education workers over August and September, because more went into August than in September. Seasonals pushed down the overall numbers for education. But service providing, look at that, 244,000. Of those service jobs, retailers were gained just 1,100, and professional services was the big winner, 46,000. Do companies, are they hiring at this point on the temporary side because they're not sure where the economy is going? Real estate was the last number I had on there, 5,000 jobs gained. That was the number, the sector that was supposedly collapsed during the month. So it's kind of hard to know what happened there. Bottom line, participation rate falls, and that makes the unemployment rate go down. More people hired than lost jobs, but participation is the key to the unemployment rate this time.
With that in mind, Mike, do we have to put our soft landing supply side dreams on hold?
No, I mean, you've still got a soft landing in these numbers because you've got a fairly strong payrolls report. 263,000 is above the 191,000, which was the average for the 5 years before the pandemic. So still a strong report. 3.5% ties for the lowest that we've had.
Futures extend declines, yes, as expected.
And with average hourly earnings going down, the Fed is on track, at least, to get to where it wants to be.
Mike McKee, thank you. How much pain, how much damage will they need to cause to get there? Futures down by 1.25% on the S&P. The conclusion for many is this Fed has more work to do. Yields up at the front end by 4 or 5 basis points on a 2-year, 430. On a 10-year, 388. Yields up.
So the buy didn't quite make it.
Rick Reader joins us now.
By the time you get to the candle here, look.
Let's start here.
On the 1 minute, check on the 5, the candle's red. So that's why you don't enter, because you've got 3 reds against the 1 green. And even though the volatility is where it needs to be, it's coming down. So that's how you avoid any kind of faults. You could have got it in on that buy signal here. I'd say you can see there, we could have got that candle there and scalped to the outer of the blue line. I would have done. And then you could have gone again to the red line, and that would have been done you. But in terms of entering on this candle here, it breaks inside the bands. I want to see a green candle on the 5, and you can see it's a 5. So hence why we've had a little pullback, forming a nice little, hopefully a little double bottom. In fact, we're going to move this line here and just stick that there as a nice support. So you can see we're forming a nice little wave, and we could get a pullback up to middle or the outside of the red. You can have a look on the fib as well and set the TP there. If it breaks here, there's your line, and then you're looking at 382. So that's where your TP could be if you're looking at a buy, just below the 382 on the 5-minute fib, which is there. And look at that, happens to be the center band of the 1 minute, so it's perfect. And then your second TP would be the golden zone back into 0.5, just below it. And again, these, I don't leave these because it moves. Obviously the fib moves up and down as price action moves, but this is just if you were entering now. Look, you can see that you've got an easy TP1, TP2, TP3, or you wait and don't take a buy until prices broke this line here, and that will be your second leg of the W going up, and you should be able to get a TP1 and possibly TP2. And that's how you do it, just using them from the 5-minute fib. It's so easy, and this is drawn automatically for you. Your stop loss below the last swing low, of course. You know, it's not rocket science. You just stick to the rules. Don't be too aggressive on your entries, and stick with lower lot sizes until you're confident.
That being said, Jonathan, I mean, what you have to take some thought on or perspective on, this is if you're a fixed income investor, The next few years are going to be, I think, extraordinary. You're pricing yields to levels that we haven't seen. I know it's, I think, on that podcast as well. Like you can sit and wait in cash in short duration assets
I'll do.
and get paid.
As we're getting towards that open.
This is creating an environment that, you know, markets have to recalibrate every few years. This is a massive recalibration. By the way, John, my partner Bob Miller reminded me this morning that in March the fund rate was at 0 and the Fed was doing QE.
Yep.
And you think about now we've got the price and terminal funds rate, you know, closer to 475. That's a lot of movement in a few months.
They've done 300 basis points in 6 months. I think it took them 3 years to do anything close to that in the last rate hiking cycle. Rick, you said a few years, and I just wonder, can we get to that new equilibrium with Fed funds in and around 4? Can we get there and stay there?
So listen, I mean, I think the Fed said you got to keep going. I mean, there's something that's really important per my comment. You think about where we've gotten to. Your point about how much they've raised the funds rate, and then, by the way, they're draining liquidity. If you think about since where we were in December, you've drained $1.3 trillion of liquidity. You've drained $300 billion in the last month. Rates higher, liquidity getting drained. By the way, this will have an impact. And so part of why I think the Fed's going to get to the number and then pause for a while, and I think you get a 75, you probably get another 50, we can debate another 25. You just did an immense amount. You've got to let the system, we've got to see what happens to business spending, what happens, you see these openings drop like a stone, job openings drop like a stone. So I think you got to see a little bit. When people say you got to keep going, listen, the Fed was easing too long. Now they're tightening unbelievably, historically aggressively. Think about it, if they go too far, then you got to start easing again. It's crazy. I think you've got to let the system recalibrate. Let's see, because this is historic amount of monetary tightening.
Rick, you've been in cash for a while. You've carried high levels of cash through much of this year. We've talked about it a fair bit. If they start to decelerate rate hikes from 75 to 50 to 25, is that sufficiently good news for you to say it's time to add a bit more capital?
Nice push up, but the momentum's not in the right place. It's got a range, hopefully.
We got the CPI data coming out next week. We're going to hear.
Oh, well, there's 236 before we get to the open. Let's see if we get a break.
More about UK utility prices. We got a lot of data coming the next month or two. If the data, you know, we've been getting a lot of bad news. If the data starts to suggest, you know, economy in the U.S. moderating, we're getting through.
Oh, did you see? Look at that, smashed all the way down. 1690 before pulling back.
Or at least we know what the news is 30 days, 60 days hence.
So those initial levels are set for NFP, and you can see they were well smashed. I've reached the bottom, got a retracement, fibs redrawn nicely. So again, you could have gone in on that. As you look, the candle pulled back inside the bands. Your 5-minute candle is also green, so that is a valid buy there. Momentum's where you need it to be. So you could have taken that one.
And then, you know, if you get that deceleration and it looks like the Fed's going to pause, you could have a pretty good environment.
That would have been.
What do you make of how credit's priced at the moment in high yield? I look at spreads, and spreads don't
Vented on that.
Recession. I look at price and yield, and maybe.
And so you could have gone 455, 400 points nearly, 45 pips. Again, I just gone for 10, 4 or 5 trades doing 10. That to me is the safer way. I might be paying more in commissions and spreads, but I'm not hanging in the market longer to try and recoup everything. Makes sense.
The fact that the risk-free rate is now pricing at an attractive level, that, you know, you build that spread on top of it, you can buy high yield at 8, 9, 10, depending on how much risk you want to take.
Well, we're just going to top our coffee up again, and we'll be back in 5 minutes, ready for the open. Back in a sec.
I still think you've got these things to work through. But listen, at the end of the day, if you said to me, would I rather book a 9 than worry about equity beta with margin compression and earnings flatlining to I think slowing, I'd like to take income into the portfolio. I think carry is pretty attractive. So I lean on the side of, by the way, I like it a lot more than real estate today.
Yeah.
When you ratchet the mortgage rate up. So I tend to like it, but listen, I think you got to be reserved in the size of your positioning today because of all the aforementioned.
Rick, the risk at the moment for many people, particularly over the last few weeks, has been in the risk-free asset. And one question I've asked a few times, and I'd love your response to it, If we're struggling to price the risk-free asset up 20 basis points, down 20 basis points on any given day on very little information, how do you price risk assets?
You can't. I mean, that's why liquidity in the markets, John, is so atrocious. It is. You can't. I mean, it's so hard. I mean, it's, you know, every financial asset we look at is the risk-free rate plus the risky rate, and if your most conservative part of that equation is bobbing all over the place, you can't. It's super hard. You've got to expand your bid ask, as it were, in terms of, you know, what's your entry point on an asset. And I think that's the way you're going to be for the time being. But let me. I just want to put this a bit in perspective. Sure. It is my favorite asset. Amazon, 2.25 years ago, when rates were at zero, issued a 3-year at 0.25%. We were funding Amazon at 25 basis points. It's now a 9-month bond that you can buy at I don't know the exact level today, but it's back at 4%. And so you think about that. Now I'm funding, because of the risk-free rate, my real rate of return on the asset, pretty good. You know, particularly you look at inflation break-evens in and around 2. So it was a pretty interesting time to say, gosh, I need to expand my time horizon a little bit on assets that are yielding these sort of levels. And you know, these are particularly if you can stay in the front end. You know, if you buy now a 3-year asset that's a 1-year or less, or a 9-month with a nice yield to it, that's pretty intriguing.
So, Rick, this gets me to the final question. You just talked about the change we've seen in Amazon in a few years. It feels like a few long years. We've just blown up a decade of negative rates, even negative rates in the corporate bond market, zero rates at the Fed, QE, trillions of it. Rick, there are some people out there that just struggle to believe that we've fully realized the spillovers from that we can really go through the next couple of years without the default rate picking up a fair bit. What do you say back to them?
How much longer do we have?
You can have a couple of minutes.
I think it's really hard, Jonathan. I mean, listen, I don't think it's a given that you assume that, boy, now the thing has to break. Listen, I hope negative interest rates is finished for the rest of my career. I don't think it works. I think you create these anomalies in the system. I don't think it adds to velocity. It penalizes your pension system, your insurance system. It dulls investment. I don't believe in it. But what it did allow is it allowed companies to term their debt out. It did allow companies to get healthier. And so to say, you know, we've got to see all of this unwind. Well, you're gonna slow an economy with a paradigm where you've actually got, by the way, not just companies, households. The household wealth and debt ratio is much better. The lowest part of the income strata is in a tougher spot. But generally, consumer leverage is okay, financial leverage is okay, and corporate leverage is okay. So, you know, whether you know low rates allowed you to do all that, there is a fair argument to that. So, you know, to say now it's going to unwind, it's going to create a problem, you know, the system's in reasonable shape. By the way, the debt's on the government's balance sheet, which is not perfect, and will dull your fiscal expenditure, and certainly the cost of your fiscal expenditure. But listen, I think the starting point is reasonable, and to say, gosh, now the thing's going to tip over and it's going to get a lot worse, you know, I don't see that. What creates stress in the system is leverage. I mean, in every time we go back to Asian crisis, et cetera. Now the leverage is not bad. It's on the government's balance sheet, which you can handle a bit better. By the way, some parts of the world that are dollar liabilities, not so much. Yeah. But you can generally handle it a bit better. So I'm not in the, gosh, we're going to have to, this thing's going to be a disaster. I just don't buy that. And by the way, I don't think soft landing is an impossibility per what we're seeing play out today. But again, we got to see a lot of exogenous things, global dynamics play out over the next couple of months.
Hey, Rick, awesome to catch up. I know you don't rest much on the weekend, but get some rest. We've got to do it again Monday. Rick Reader there at BlackRock. Thank you, buddy, as always. Futures down about 1% on the S&P. Yields are higher. Coming up, the payrolls report. Keeping the Fed on track.
We just now need to stay the course. We said we're going to do this. We need to follow through and validate the expectations that we've set in markets.
Payrolls and politics, what the latest jobs data means for the Biden administration. That conversation up next.
What is the main reason institutional investors give you for not adopting crypto?
There's still a lot of regulatory uncertainty. The U.S. has been not good at making things clear. What's a security, what's not a security.
With iCapital's Anastasia Amoroso and PGIM's Mike Collins.
go.
After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun.
We are joined by UCLA quarterback Chase Griffin. Not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. Welcome to Bloomberg, the lineup.
Innovation, money, and power collide in Silicon Valley and beyond. Bloomberg Technology with Emily Chang. Weekdays at 5 p.m. in New York and 2 p.m. in San Francisco.
I think we're quite a ways away from a pause.
Restoring price stability likely will require ongoing rate hikes.
Somewhere between 4 and 4.5% by the end of this year.
I anticipate additional rate hikes into early next year.
Headed for 4.5 to 4.75% by sometime next year.
And then hold at that level
as we continue to move into more and more restrictive territory.
Can we achieve a soft landing?
Until we see inflation truly get close to 2%.
Stay the course.
We're all waiting for inflation to peak.
I'll be watching the data carefully.
That's going to be really critical for policymaking.
Stay the course. Fed officials sticking to the script and doubling down on their plans to tame inflation. The latest payrolls report giving the central bank a green light to keep going. This as the Biden administration faces a string of economic tests ahead of midterms with CPI, GDP and another rate hike still on deck. Bloomberg's Anne-Marie joins us now from DC. Morning, Anne-Marie.
Right, here we go. Let's see. Let's see what move we're going to get. We've got 10 minutes to go. We're back. Coffee topped up. So look at US 30, how it's holding nicely. Hit that centre of our band, as I said. Like I say, are we going to get a further push up, or is it going to come back down and retest? So let's see, we'll just post that. We've got about 9 minutes to go.
The issue is inflation. So for this administration, what voters care about is next week's CPI.
Thank you. I think next week's CPI is going to hijack.
Yes, next week's CPI.
Down in Washington, D.C. Joining us now is our Capital's Anastasia Amoroso, P-Jibs, Mike Collins. Anastasia, wonderful to have you back. Your response to the jobs report 50 minutes ago.
Well, it came in right under the nose, in line with expectations, but unfortunately the challenge is this shows that the labor market is slowing, but is really not weakening. I would say there's broad-based strength. Most industries are still creating jobs. As Anne-Marie mentioned, the unemployment rate is at 3.5%, which aside from pre-pandemic, you have to go back.
And cable as well, as I say, skewed up.
See that. So it's still an
Look at that, beautiful little pull.
And here lies the challenge for the Fed. I think they want to crack the labor market, and there's
There we go. I'm just going to set the line for that for when it's.
So Jonathan, as we see the
If you guys want to have a go at trading NY cable trade, will be then. Don't trade until after that line is crossed. We have a look.
So between those two things, it's really tough for equities right now.
Mike Collins, your thoughts on this? And I just want to throw in this quote from Ian Shepherdson at
And say if price is below that line, we're going to get a pull back to it. I hope. Let's see. That's our Asian line. So.
And a statistically insignificant increase in the labour force combined to generate statistically insignificant falls.
So it's going to be around about here.
Like, I don't know if you got all that, but in response to it, please.
So yeah, it's fair enough. That's the new line.
The economy, right? It's good news for those in the soft landing.
It's right where the supply and demand zones are. That's why it was ranging. Then broke for NFP.
For consumer spending, but as we all know, it's all about the Fed. It's all about central banks, Jonathan. It's all about
clear that out.
Policy, how tight
tidy up the chart. There you go. So want price really to come back. The further away from these lines, the better. Let's see if we can buy right at the bottom of the bands and back up.
If this Fed sets the stage to go from 75 to 50 to 25, Rick Reader and I spoke about
Ooh, the futures on NAS. Should have done NAS actually. That'll be trade more NAS next week. And like I say, hopefully all being well next week, we'll be doing some live streams towards the end of New York session. So the last hour or so, which is later on in the evening here in the UK. So people can join in, do some true scalping, and maybe trade the oil news, any speeches that might be, reactions to CPI, stuff like that, and see if we can get some pips at the end of the session. Just switch it up a little bit, using the same system, the same strategies.
And as rates rise across the board, there's going to be more slowness and potential for a recession. So the markets will have to price that in, and that means the EPS downgrades are likely still to come. So even if we get some sort of a pop because of a so-called Fed pivot, the reality is the relative value of equities is quite challenged when rates are close to 4%.
Well, we're getting a drop now. On the S&P, we're down by a little more than 1%. Yields are higher at the front end through much of this morning on a 2-year, on a 10-year off the back of that payrolls report. On 2s, we're up 4 basis points to about 430. Anastasia, Mike Collins, going to stick with us, I'm pleased to say. Coming up in the morning calls and later, The View from the White House. We'll catch up with US Labour Secretary Marty Walsh responding to the Labour report.
Is spread betting right for me? Get more flexibility. Benefit.
Looking forward to doing that with him in just a moment. That conversation just around the corner.
RSI's pulled back from that oversold zone. Like I said, but I don't take buys coming out of the zone. I'll look to get back into that central part. That's our signal on potential sell on pound dollar. You can see it flashing in there, look. Repaints, obviously, once it sticks. RSI is just right, so it's looking good. There's 10 pips down to the outer band.
We were thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that
I have it set at 1 per bar, but you can have it set 1 per bar close, so you only get the notification when the signal actually sticks. It's just to help, it's just an extra crutch to help people.
And it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable.
So back to US 30, so what we're focusing on for the open.
Sustainable materials, and in doing so, we could take a really interesting leadership opportunity and grab that and
now we're going to go lower.
A totally different story, compete on a totally
And we've got basically, oh, there's 100 pips to that bond. Okay, 3 minutes to go, everybody. Good luck.
Equities down, yields up, about 5 minutes away from the opening bound. Post payrolls, equities down a little more than 1%. Yields higher by 4 basis points on a 2-year, just south of 430. That's the price action. Here's your morning calls. First up, RBC downgrading lift to sector perform, slashing its price target nearly in half due to competitive and structural headwinds. They're downgrading Norfolk Southern to neutral, highlighting potential downside given the weakening macro economy. And finally, KBW upgrading Goldman Sachs to outperform, expecting shares to move higher after earnings later this month. Coming up, it's the opening bout. Much more with Anastasia Amoroso and Mike Collins, plus a conversation with US Labour Secretary Marty Walsh. That conversation still ahead. Equity futures down by 42 on the S&P. We're negative a little more than 1 full percentage point. Yields higher through the curve on a 10-year, up 7 to about 389. Your opening bout up next.
We've got about a minute to go, everybody. So let's see if we can end the trading week on a nice winning streak. It would be nice. See the band's narrowing. There's still plenty of room here to grab some. Just going to take the line away now. Don't need to see that. Are we going to get a market manipulation push up past 382 before it drops again? Like I say, forming that double bottom. Or we're going to get straight down. Let's wait and see. This is the fun. Well, the T is really low. Look at that. It's waiting to pounds. Done at 12. Momentum. Right, good luck everybody, 30 seconds, right, logged in, yep. There we go, and get ready, fingers on your buttons. 10 seconds.
But this is just one side of the coin. It's not enough to simply generate green energy.
Let's see if it's going to push.
Split it and distribute it to the end consumers.
The grid of today just isn't equipped for renewables. So a new kind of grid is starting to take shape. The supergrid.
The difference between political gossip.
Just waiting for the move, no positions taken yet. So see if it's going to break that 386 for a buy or whether we're going lower.
And public affairs tools that give you the edge in reaching policymakers on the Hill. When you're in the business of influence in Washington, information
Pushing down. Pushing down and we're done. Yay, we got in and out there. Excellent. Sell signal's going to hold. I'm ready to go back in again. We managed to get 1, 2, 3, 4, 5, 6, 7, 8 trades away there. 8 positions away. That was really good. And that was another 30, 40, 50, 60, 70, 80, 90, 100. So another $100 away there. When I see them signals, they're very reliable on the open. Get out before price hits the bottom of that zone, of course, as you know. So that was a nice. I saw that signal flash in, just waited for the move and then entered, and there you go, and then took my profit. And again, I'd set it at 3, 30 pips, took some just before and the rest after, so that's took us to 81.2% return. Look at that beautiful move now. The open is on. Let's wait for another move.
What are we, about 25 seconds into this? Let's get you some movers. Here's Abby.
Given the solid jobs report, John, we of course have the familiar story, as you've been talking about all morning. Yields up, stocks down. So let's keep it macro. One of the big drags, of course, Apple down 2%. Yields higher, mean technology is down even more than other stocks. Valuation really comes into concern. JP Morgan Chase, the bank's lower even with yields higher, and as the yield curve inverts less, that would typically help out banks, but that's really not the case. One of the conundrums of this year. We do have a little bit of a bid for the energy sector. In fact, it's the only sector higher at this time, with oil up 1%.
So we'll see if we can get a re-entry. I hope you guys got some on that sell.
Sales by $1 billion. There's this sign of a PC slump. This stock, John, is now down more than 50% this year. Of course, Morgan Team is warning that it could, in fact, even get worse.
Thank you. Picking up on the energy story, the outperformance of energy relative to information technology. Story of the session, story of the year as well.
That was a nice and smooth move. Not entering again. Why not at the moment? No, because obviously we're going to have a bounce off this support. So let's see if we can get buys going now. But you want to wait for that in case the sell signal disappears. But if it doesn't, then we're going lower. Like I say, I'm 80% up, so I don't have to risk and don't need to risk anything else. So you know, it's good. That's, you know, that's all in the space of an hour. Just true scalping practice. There you go, look, and so it starts to flash. Looking at the 1 minute, it's pulling. Are we going to get a push up? Just watch RSI as well. Look, see if it kinks up. Don't be taking any buys in the downtrend like this just yet. I can move this arrow now. Nice rejection. It's going to push back down again. Price is trying to come back up. Like I say, you can set your the TP I would be going for when a buy occurs is there. So that's where I would be setting my TP on this once I get a confirmed buy, and then we can go higher after that. But at the moment we're still pushing down. The sell signal is still valid. Like I say, these signals are really good keeping when everything's lined up. You've got the trend bar, it's red. We've got the RSI that's red pointing down. It's 30, it's low, and there we go. It's hit now. Some of you could have held for that to hit that level of support as the TP. If it breaks it, we're going lower. Otherwise, we're going to get a lovely. Look at that W. Could be great. I think the momentum is too high to the downside at the moment. But you know, you're just silly trying to look for buys on this pullback at the moment. Pound dollar ranging. So again, you can wait for the trigger when it hits this line to see how close. See, we're looking for buys on cable as well. US 30 probably just going to range line, just rejected off that bottom of our fib on the 5, as you can see. Set here, look. That was your TP for the sell. If you wanted to hold rather than do what I do, that's totally fine. But hit it, and now hopefully we're going to get a push back to form, like I say. We had a kind of a W there. It's a big one if you want to take that as the center. But we know price will get back into that center zone if nothing else. That's what I want to wait for.
Hey John, I can't believe we're already here again, and I would just like to remind our audience what happened in the aftermath of JP Morgan kicking off earnings season last time around, and that was actually a pretty healthy rally. From mid-June until mid-August is when we saw that 17% gain in the S&P 500 before we started worrying again about the macro policy picture and everything started to...
The sell's still valid, look, you see. So again, if you look, red, and on the 1 minute the same red candle. So that's what I look for, all confirmations on the smaller time frame, the bigger time frame, my trend bar, RSI. That's as good as you're going to get, and you as a trader, you've got to take the trade. If it goes against you, you've not done anything wrong. That's just the market, it's part of the game. But you can't be sat there when you've got all confirmations dithering. You need to go in, and then it's up to you whether you decide to hold, just get some green, get out, or you want to set a level and all the rest of it, or do a loss to win ratio, whatever. You know, you guys know all the different ways of doing it. Me, I'd just like to take some green, get out, and then go again. Again, trying to break that zone.
That's the big one when we get all the big tech players, the alphabets and apples of the world. 15.3 trillion.
RSI still 28. I want to see it curling up and approaching the neutral to be looking at a buy. So you either want to do a continuation trade on this if it's breaking. As you can see, we're going to go lower, or you wait now for the buys. For me, I like to trade. I don't like to trade when price is at the extremes unless it's a news event. If there's a news event coming up, like I say, I'd still be cautious, but I'm only looking for buys now. If you say to me, Roy, you're looking at US 30 buys, that's it. I'm not bothered if the market goes lower or lower. I'm waiting for the reversal. I like to trade the reversals. I've been in on the trend. I've already taken my profits on this move.
Market, and we don't need as many laptops and computers as we did during the pandemic.
So I'll just post that and say to everybody, just wait and be patient for that move.
For example, and that's going to negatively impact potentially the semiconductor trade. And then eventually, I think the auto market weakness is likely to come to fruition too. So I just think semiconductors is a tough place right now, and it is really showcasing the slowdown that we can see in the economy. So that's one thing I wanted to comment on. And then speaking of other places where
And we might get a signal or something like that to help us. There's different ways all built into the system, can give us confirmation, a heads up when this might occur.
And so one concern that I'll be watching for in this earnings season is what happens with delinquency rate, what happens with net charge-offs, are there any red flags that the banks are already seeing now, and most importantly, are they going to be provisioning for it? So my sense is most banks are likely to take a cautious approach, and instead of being a tailwind, which was this release of low loss reserves, it's going to become a headwind because the banks will want to prepare for not a soft landing, but eventually a recessionary scenario. So those are the red flags. And energy, John, is a trade that we've liked all year and continue to want to buy on the pullbacks, and that view certainly has not changed.
Let me just unpick the bank story. That's from the equity side. Mike Collins, I get a feeling you actually like it from the fixed income side of things. Why is that?
Yeah, there are a lot of sectors we like on the fixed income side, Jonathan, because again, if you look at the underlying fundamentals in the debt markets from a credit risk perspective, default rate expectations are going up, earnings expectations are coming down, margins are getting compressed. But are we going to have a big increase in defaults? Are the big banks going to default on their debt? Unequivocally, no, right? And are they, providing really attractive...
Cool, so answering some questions. So yeah, there we go. I think we're going to call it a day. That's it. Like I say, when you've done what you need to do, just close your computer, laptop, phone, whatever, and end it. That's it. Like I say, I'm looking for buys on the US 30 if I was still going to be trading. Cable, I'm looking for buys as well, back up to our zone there. It's exactly the same. Just going to post that into the group. I post stuff into the group so people can follow what I'm doing, and it's their decision whether they want to take the trade. But I'm giving them the setups and what to wait for. And so if you want to join the group, just go to www.mohawkforex.com, and all the links and everything are in the description of the channel below. So it's been a great trading week. Like I say, we've finished for the week 89% win rate this week, so that is really good. Happy with that. Another successful scalping week, and we'll be back next week. It's going to be just as good with CPI as well. So again, to everybody into my team, thank you for watching and joining in. Please give this stream a like, subscribe, and you'll get notifications when I'm live next. And like I say, we'll be doing some live streams at the end of market sessions next week as well, all being well. But again, till then, I'm glad you enjoyed NFP. Stay strong, stay safe, and catch you on the next live stream. Take care, everybody.